what's happened is that economies have proved to be remarkably resilient. We're not seeing a global recession. We're not seeing a recession in the United States. We're not seeing a recession here in Europe, or indeed in Japan. But what we are seeing is a growth slowdown. The world economy is holding up. We are seeing some signs of trade diversion. Exports into the US are more challenging now because of the tariffs. But China seems to be exporting more to other parts of Asia, in Europe. So that's it. We're not seeing a big surge in inflation in the States. It seems to be, quite transitory, and that's good news for financial markets. That means that interest rates are not going to be going up. It means that growth, therefore, will probably continue to chug along. And as a result, we're seeing, equity markets across the globe, at record highs. And that too is just feeding into a positive story for economic growth. So we have seen tariffs go up this year, and the economy that it is affecting most at the moment is the United States economy. It has led to a sharp rise in uncertainty amongst consumers and businesses. We are seeing cohorts of the US economy really begin to slow down, particularly lower income earners are suffering under the higher tariff regime. As a consequence of the weakness and uncertainty, we are seeing the US labour market slow down. Jobs growth is running at a very modest 30,000 per month on a 3-month moving average basis. And we think that is consistent with a gradual rise in the unemployment rate over time. What that means is that the Federal Reserve have started to cut interest rates again. They've recently cut interest rates by 25 basis points. And our forecast is that they will cut rates by 25 basis points at each of their next 4 meetings, taking the target for Fed funds down to 3 to 3.25%. What does that mean? I think it means that monetary restriction in the United States is going to be dialed back in coming months. That's going to be good news for interest rates. It's going to be good news for borrowers. It's going to be good news for consumers. And it's going to be good news for businesses. As a consequence, we think the economy is going to avoid recession. We do think that domestic demand growth in the United States will slow quite a bit into 2026. But at 1%, whilst weak, it's not at recessionary levels. Thereafter, we think in response to interest rate cuts and as the economy settles down to the reality of what the tariffs are at the moment and greater policy certainty going forward, we do expect for a very gradual recovery in economic activity towards the end of 26 and into 27 in the US. As far as Europe is concerned, our sense is that the ECB has been very proactive in cutting interest rates. As soon as inflation showed signs of falling on a sustainable basis 15 months ago, the ECB embarked on a series of interest rate cuts, cutting the key benchmark rate by 200 basis points. We're seeing a very positive response to that in the economy. We're seeing the level of mortgage demand pick up, we're seeing consumer credit pick up, and we're seeing borrowing amongst non-financial corporates pick up. That's really good news in terms of supplementing the recovery going forward. Now, Europe is a very open economy. It cannot rely against higher US tariffs, and I think increased competition from major trading blocs like China on trade and increased exports to drive growth going forward. So my sense is that European demand is going to have to be driven domestically. The fact that interest rates are coming down will help to drive the savings rate down and encourage greater spending. Real incomes are rising gradually, and fiscal policy is expansionary. So we actually forecast that euro area growth will rise 1.3% this year versus a 0.8% increase in 24. And we think that gradual momentum increase is going to continue. We look for growth to rise by 1.5% in 2026 and 1.9% in 2027. So really quite an encouraging story for the European economy. Of course, things like increased defence spending, the end of the debt brake in Germany are all positives as well. But the fact that the labour market remains at very solid levels with unemployment at historically low levels for Europe, I think means more people in work. With real wages rising, there's going to be more money to spend, and with interest rates coming down, it's cheaper for people to borrow. So a good growth story here in Europe.